Hi, everyone. This is Rob Roy, and welcome to this week's Elliott Wave Options U.S. Market Update. As we do each and every week, we show you the stocks on the screen that'll be featured in this recording. And as a reminder, if there's a particular stock you're interested in, you can go directly to it using the chapters feature in this video. Also, like last week, we are recording this on Friday during market hours, so prices could change a little bit into the close. So, just a quick reminder there. All right, so we did have some economic news to talk about. A really big Fed meeting, long-awaited uh, nod from Chairman Powell for a rate cut. That's what the market expected, and he said it's on the table. So that wasn't really a commitment, but the market cheered it. We had a big rally to the upside on Wednesday, and then now we have the jobs report that came out this morning, and it's starting to show that the economy is weakening significantly. So, a disappointing jobs report this morning. Unemployment has gone up. And so now, where we sit is the market is concerned that the Fed is too late to the party on the rate cuts. Even September might be a little bit too late. So, as you all know, I've been saying this. I was in favor of or really felt we were going to get the December rate cut. The Fed didn't want to do anything before the election, but I think their hand's going to be forced. And so I do think we're going to get that September rate cut now. But again, it seems like the market is concerned that's too little too late. So let's look at the charts and I'll show you what I mean. When we take a look at, we had this gap up here on Wednesday where we moved to the upside. And that was a really outsized move as we were up with the futures before the Fed announcement came out, and just stating that a September cut was on the table seemed to be enough to satisfy the markets. And then all of a sudden, it's like, all right, yesterday they're thinking, is that soon enough? Things are starting to look a little bit weaker, and maybe the Fed's going to be too late to start cutting rates. And so we went down. And then we wanted to see whether there's follow through. We talked about this in our insiders meeting last night, which we do for alert subscribers only at ewotrader.com, and said we'll see if there's follow through because we had closed Thursday right on the 50-day moving average. Pardon me, that's the royal blue line. I also drew this support line because that's where the previous wave 3 high was. It's also where support from May came in. And if we broke below the 50-day moving average, we could move down there. Well, guess what? We've already done that today. So, pretty ugly day today. Follow through to the downside. We're sitting right now at a 50% correction where we had been holding at that 38.2% level. So now the question becomes, can we hold here? And if we don't, if this is the end of the wave 5, right at that 78.6% fib level, we may get a little bit of a bounce here because we're oversold now with today's move to the downside and where the 10-day moving average is. But if we break below this level, then we're almost certainly coming down to the previous 4. That's Elliott Wave rules. You have a wave 5 that doesn't extend more than 100%, then you head down to the previous 4, and that could be in play. But like I said, we're a little oversold right now, and we'll see if in the beginning of next week we get some sort of a little bit of a bounce back up, maybe to test the 50-day moving average. But the melt up scenario is looking less likely, at least at this point. And all we can do is read the charts as they appear to us at the moment. All right, so that's the S&P. Now let's take a look at interest rates. And when we take a look at the TNX with rates, you'll see that we've moved down to that 161.8% extension. Been talking about this quite a bit during TradeFinder on Tuesdays because we had this move down to this 100% extension, and then we retraced back up to the previous Fib level, which allowed us the opportunity based on Elliott Wave rules for zigzag patterns to move down to the 161.8% level. And what we've been talking about during TradeFinder is I didn't necessarily think we wanted to go down that level. I know it was counterintuitive. The market has been loving lower rates, but at this point in time, if we were to go down there, it means the economy is weakening significantly, and that's why rates are going down. And that's exactly what's going on right now. The market is concerned that the economy is going to get too weak, and by the time the Fed gets enough rate cuts in there, more damage is going to be done. So all the way down, right spot on to the 161.8% fib extension. So classic Elliott Wave zigzag rules. where you go down to the first extension. If you're going to have a further extension, you're supposed to test the previous fib level before moving down. And that's all exactly what played out, and also the concern of where we could go from here. And by the way, if you haven't signed up for TradeFinder, you can see that link on your screen. Register there. We do it every Tuesday at 1 p.m. Eastern Time. So it's during market hours. We look at the market, we look for trade ideas, and we have a live Q&A. It's a great community that we have. Ask great questions. Look for stocks. If you have a stock of interest during the Q&A, we can look at those as well. So love to have you join us in next week's Trade Finder. All right, so that's what's going on with rates. Now, I am going to jump up to TLT now while we're talking about rates. I know a lot of you ask about TLT quite often, but here's a clear sign with this move to the upside here that trouble is afoot. The bond market has told us that by having the inverted yield curve for so long. It's finally starting to come to fruition. The bond market is rarely wrong. It's huge, a lot of smart people in there. And the fact that people are buying out to 20 years. So TLT is 20 years. Now, remember, TLT is prices, where TNX is showing yields. So prices go up, yields go down. They move in inverse proportion. So the fact that we're getting this rocket ship up here on the 20-year is concerning, that people are willing to park money for 20 years now. So they're concerned that there's some really nefarious things that may be afoot here, at least for now. So I wanted to go ahead and show you that. We are a little bit too far to the upside here on TLT. Pretty good separation from the 10-day moving average, vertical move, gap up, all the things that tell you that maybe this is a little overdone short term. What goes vertically up oftentimes comes vertically back down. Gaps get filled. No security in any time frame. Gets very far away from the 10-day moving average. Those three main rules of trading that I talk to you about so often, all being evidenced here in the chart of TLT. So let's see if next week things calm down a little bit. If not, this could start to get pretty ugly in the markets, because there is no Fed meeting in August. So September is the first time they can cut, unless they did some sort of emergency thing. And I don't really think they're going to do that. So now let's go and take a look at the dollar, see how the dollar is faring here. And I think it's kind of wild that the dollar is holding right here at this 104 level. Why? With rates going down, you would think that that would send the dollar down. Perhaps it's because we're getting this um, weakness in the economy and some money is moving in to the dollar. But I would have thought that if that was true, we would have gotten a little bit more of a bounce to the upside in the dollar. Seems to be just enough money moving in to hold it from falling with rates going down, but not enough to cause the dollar to go back up to the upper end of this trading range that we've been in since April. So I think the dollar is going to be really interesting to watch at the beginning of next week. If we break below this 104 level, then we're most certainly coming down at least down to 102 in the dollar. And then you start to wonder if there's concerns about the amount of debt that we have. With rates going down, that does help the U.S. government in the fact that it doesn't cost as much to service that debt, but still it's a problem. And within a weakening economy, it exaggerates that problem. Now let's look at the VIX. And holy cow, we were talking about this last night as well. Moving big to the upside, nearing 20 again today. And we're wondering, we were discussing this last night, is 17 and a half going to be support now? Sure hope not. I hope that we get this out of the way and we come back down. Otherwise, if we continue to spike higher in the VIX, you know how it works. That means the market's moving lower. But perhaps we back off a little bit. We let the market satisfy this slightly oversold condition that we're in right now. Maybe we bounce off that 50% level, and then the VIX gives us a little bit of help with a movement back down inside this trading range. But can you imagine the scenario if 17 and a half starts to become support rather than resistance? Then I think that the next level to look for would be up here near 22 and a half. So there is a possibility that we move into that trading range. But we can't say that yet. We got to wait and see how things play out over the next couple of weeks. Now let's take a look at some of the rest of our markets. The Dow, looking there, you can see ugly day here as well. Now the Dow had looked a little better than the S&P last night. It had closed right on its 10-day moving average. And now we're breaking below this support level that I'd drawn here right at 400. So we've given that up in a big way today. Ugly day on the tape of the Dow right now, breaking below the 50-day moving average. And at this point in time, we could retrace this entire C wave of this zigzag, which means you could see the Dow go down here to 385. It is in a wave three, and perhaps that gets relabeled unless we hold right here and start back up and we label this area as the four right here at the 50-day moving average. But it sure doesn't feel like it today. But once again, a gap down, a little too far away from the 10-day moving average. So the most bullish scenario would be if we get at least a bit of retracement back to the upside at the beginning of next week and see if we close these gaps, test the 10-day moving average, and then all bets are off as far as where we go from there. So I think we get a little bit of an oversold bounce to start the week, and then we reevaluate at that point in time. And Tuesdays, TradeFinder will be a good place to find out where we are, what happened on Monday, and where do we sit midday Tuesday. So once again, sign up for that TradeFinder. Looking at the Qs, well, you can imagine that this is pretty ugly with the big caps, and it is. It's breaking below its previous wave 5 high. In today's move, same theme here, gap down, oversold from the 10-day moving average, but there's nothing to stop the Qs now other than some sort of a short-term bounce to satisfy the oversold condition from coming all the way back down here, retracing this entire C wave and bringing us somewhere down around 410, 415 or so on the Qs. And with rates going down, if that can't propel the big tech stocks, then it looks like there's some profit taking going on from institutions that have owned it. They don't want to see all of that they've earned go away. So we could see a pretty good move lower continuing in the Qs. And then the IWM, this makes more sense now to me. We're certainly moving at least short term into a risk off type environment, and big movements down in the IWM. And here we go with the rules again. We broke vertically out of that triangle. We did do a pretty good job of consolidating here for a while, and then it just gave up the ghost and then vertically back down. But once again here, now we're a bit oversold, a little too far away from the 10-day moving average. And remember the other Elliott Wave corrective rules, triangles, you normally come back to the point of the triangle. So that would bring us all the way back down to just above 200 on the IWM. And maybe we go back into that 190 to 210 range. But once again, we'll see if we get a little bit of a bounce off of this 210 level. Seems like this one's set up pretty well for at least a short-term bounce at the beginning of the week. Fill that gap, get closer to the 10-day moving average, and then we'll see over the next few trading days whether or not we can hold 210 or if we're going to give that up and head back down into that 190 to 210 range. So at least this was the one that was really confusing as to why we were getting such a vertical move here. But now falling in line and making more sense. Things don't get discombobulated, is the word I like to use, for very long. Usually things come back and make a little bit more sense. Looking at Bitcoin, just can't really hold above 65,000. We did go up and look at 70,000 a few days ago, and then now we're right back down, and we're having trouble here holding the 65,000 level. And if we can't hold it, then we're probably coming back down to 60,000 again. Breaking below the 50-day moving average here. The 10-day moving average is rolling over. We need Bitcoin back above 65,000 pretty quickly. If not, then I do think we see 60,000 in the not too distant future, next few trading days. So over the weekend is going to be key for Bitcoin. And then Ethereum moving back down. And this one is just in such a good Elliott Wave pattern, very well constructed 5-wave pattern to the downside. We do have this support level right here at 3,000. Can we hold that? If not, then we'll probably satisfy this wave 5 target down here around 2750 and see if that can hold. But right now, a little bit oversold from the 10-day moving average, but not significantly so. And we could actually go lower and hit that wave 5 target there, as I said, around 2750. Let's take a look at the metals because, boy, metals are not in line at all right now. Silver really struggling, moving down. I moved this zigzag pattern in last night's insiders meeting because we had disqualified the previous one, and we are barely qualified in a zigzag now, right at that last bastion of fib support, the 78.6% level, right there at 25. We've gotten a little bit of a bounce, but we're still below the 50-day moving average on the SLV. And you know that the technology sector uses a lot of silver. And so perhaps that's why SLV's chart looks a lot more broken than GLD's does. We'll look at that next. We did come down and satisfy that point of the triangle. So we broke out, came back, tested it, and broke down. Looked like maybe we're going to come back up, but all we did was go back up and test that 38.2% extension level. And now we have to see if we can hold here. If not, then we'll most likely, highly likely, be down here at 24 in the not too distant future here on SLV, because that then retraces that previous 5. So even though we have the A label here, that's also a wave 5. It did not go beyond 100%. So you go back to the previous 4, which coincides with retracing all of that zigzag. So 24 seems to be in the cards on SLV. But when we look at GLD, you can see that it's doing better. It's hanging in there pretty well. That's why the only thing I can come up with on why SLV is underperforming gold so much is because of those ties to the technology sector. You would expect, with what's going on in the markets today, gold to be holding a bid and a little bit, but not real significantly so. And now we'll see if we turn and go higher. But the concern here is this close enough to testing the point of the triangle? You know, things aren't always exact, but we did come down towards the point of this triangle before moving back up, and we'll see how gold handles this resistance area here. If we can get gold above 230, if we can take out that previous wave 5 high, the previous wave 3 high, gold could be off to the races. That might be a place to be, and that would make sense if the economy is going to weaken, etc. So right now we're hanging in this area of possible resistance, but if we can break above it and take off again above 230, then there we go, off and running in a GLD. But we got to do it first. And remember, one day doesn't mean anything. You have to have a second day, a follow through, or confirmation day. So we're going to need that as well. Let's take a look at oil and oil breaking down. And this is a little surprising that we broke below 75. I thought that could hold. We've broken below it, and we're probably coming all the way down, retracing this point to the B wave here, and that's right around the 70 level. So high likelihood that we're going to see oil, or at least USO, back down to 70. But we are oversold, gap down, pretty significant gap from where we are in the 10-day moving average. So like the equities charts, perhaps we get a little bit of a oversold short-term bounce to start the week. But it's got to get back above 75 with follow through before we can talk about any further upside in USO. I can tell you from my travels, there's still a lot of cars on the road. I go out to eat a lot, not a big chef type person in the kitchen. And I can tell you that there is a noticeable change in the number of people that are coming out to eat in restaurants. So you're seeing that effect of the consumer not spending as much, at least in that area. Not so much on the driving yet, but we are in the summertime and people have their vacations planned, and seems like they're still going. And at this point, at least they're saying, okay, well, we're getting a little bit of a break. Prices at the pump have come down some, but not nearly as much as they should have. And you've heard me go through that, talk about when oil prices go up, you see it at the pumps the next day. When they go down, it takes forever for prices to come down, but at least they've come down some. So perhaps that's helping people continue with their plans for their summer vacations as we start to get towards the end of the summer here. All right, natural gas. I want to show you that. And you can see that we're just breaking down. Breaking down below 15 was key. We talked about this. We needed to hold the 15 level. Last week, I said if we don't get back above 15, who knows where this wave three is going to end. And clearly, we haven't. We are starting to get some separation between the 10 and the 50-day moving average. And that works very similar to when I say no security in any time frame gets very far away from the 10-day moving average. When you start to see a pretty good gap between the 10-day and the 50-day moving average, sometimes you get a bounce back to the upside. So maybe this wave three ends in the not too distant future, and we get at least a bounce back up to test 15. But we just have to see where this wave three is going to end. I love it when there's a zigzag in the wave three because that really gives you a pretty good idea where the wave three is going to end. We do that a lot for alert subscribers at ewotrader.com, but there really isn't a zigzag in this wave three. So that's the hard part, is the A wave part of a zigzag is where's that going to end? After that, we can figure everything out. So where does the wave three end? The thing that I can come up with most is what I just shared with you, that we are getting separation from the 10 and 50. So I think we're closer to the bottom on UNG than we are the top. So perhaps in the next few days, we do see a reflex bounce again, at least to 15. Then we'll go from there. All right. As we take a look at stocks of interest, the stocks that you all ask about, I'm going to look at Tesla first. We talked about this one before. And by the way, talking about the software, I mean, you've seen how great the software is. If you haven't gotten a copy of it, go to hub.com, get a copy of it. It's free, it's in beta form, nothing to download onto your computer. It's all browser based. It's a great software package. And you can follow along with all these things that I'm showing you here. We talked about Tesla and that this was my favorite triangle pattern where you have a vertical move up and consolidate into a symmetrical triangle and the potential to move to the downside. And we talked about this and said that I don't know which way Tesla will go because you never do out of a triangle, but something's getting ready to happen. And you saw it. I did make the comment that I would nod a little bit negative because we had this big run up on the fact they delivered more cars, but we also knew that they were cutting costs to do it, and that was going to hit margins. And that's exactly what happened in the report. The margins were compressed, and that's the market never likes to see that. So down we go in Tesla. I think we're going to see 200 in Tesla before we are finished here. But we are right at the 61.8% fib level. So maybe we hold just here above 200. We're awful close to it now. Little bit oversold, not as significant as some of the other charts that we've looked at. But as a quick reminder, every single month this year, we're giving away one of our free, or giving away free one of our level 3 subscriptions at ewotrader.com. They're not free; it's worth thousands of dollars, but we're giving them to you free. And all you have to do to register is post a comment under this video, and then you're registered for the drawing. And now we're starting a new month. It includes the AI-based impulse strategy. That's primarily zigzags within a wave three. The AI gives us a score on the likelihood of hitting a target. It's been phenomenally accurate. Then we also have the triangles and the volatility strategy. We don't have to pick a direction on those. They just need to break out and move, just like Tesla just did. And then we have the time strategy, which is more of an income-based strategy for stocks that have had a big drop. I think there's going to be a lot of activity in that one over the next couple of weeks for our alert subscribers at ewotrader.com. We do calendars, butterflies, things like that for stocks that are expected to stay sideways, and the AI gives us a score on the likelihood that it's going to stay in a one standard deviation trading range after the big drop. So just leave a comment under the video and you're registered for that drawing. So kind of called this one on Tesla, I think. Let's look at some other stocks that had earnings this week that everybody's talking about. Microsoft, of course, and the earnings report wasn't that bad on Microsoft. The only negative thing you could come up with is the cloud-based stuff was a little under revenues from what was expected, but everything else looked pretty good. But that wasn't enough to make the market happy. Down we go. And look at this zigzag pattern. Look where we are right now at the 100% extension after earnings. And people always ask me, do you hold positions through earnings? Well, when you have these great patterns, yeah, don't really have a fear of holding a position through earnings because it's amazing how often these patterns tend to forecast what's going to happen after earnings. And that's exactly what happened here. So now we've done is we've retraced that entire C wave. We've completed this complex part of the C wave. Now, can we hold here? We need to see if Microsoft can hold right here, right in this 407 range. If not, then 390 is next, which looks like it's a distinct possibility. But if we're going to have any sort of a continued move to the upside, we need to hold right here on Microsoft, and maybe Mr. Softy is big enough and not quite as beta as some of the other tech stocks, and maybe some money moves there for people that want to be in the technology sector down the road once this correction ends. But we'll have to wait and see. Can we hold here? As I said, if we don't, then you're going to see 390 on Microsoft. Amazon, they disappointed. So look at that. You don't want to disappoint when the market is like this because they take you behind the woodshed. And people have, what does that mean? Some of you old country people know exactly what that means. But there's a big, huge gap down. Now, talk about being separated from the 10-day moving average. This could very well be in our time strategy after today. I'll be anxious to see when the scores come out, if that's where we are after today's close, because this is what we look for: stocks that have had a big drop. And I've noticed over time that when stocks have a big drop, they tend to consolidate sideways. They almost flatline, like the stock's in shock. I can't believe what's just happened to it. And then on what I normally look for, then we AI-ified it. The Hub organization did for me, again, the creators of this software. And they give that score on the likelihood that it stays in one standard deviation. If the score is high enough, because it's certainly going to qualify on the drop, but we'll have to see what the AI score is. And if so, we could see a sideways trade on Amazon tomorrow, or Monday. But right now, just an ugly gap down on the miss on Amazon. So we finish off each and every week with India, and it's been hanging in there pretty well. But let's see what happens now with the weakness here in the U.S. So far, so good. Coming down a little bit. I had thought on this move down that we would make it down to the 50-day moving average and hit the support right at 55. It didn't. We went back up. We actually made a new high. Did not relabel to a wave 3. I think that's key. I think we have to pay attention to the fact that on this move to the new high, it did not relabel to a wave 3. Remember, I talked about, are we going to extend this 5 or are we going to relabel? And since we didn't, it looks like maybe we're finally going to get a little bit more of a correction here in the INDA. And remember, since that wave 5 went beyond 100%, you don't look for the retracement back to the previous 4. That's when a wave 5 goes less than 100%. When the wave 5 goes more than 100%, you look for a 61.8% fib retracement of this entire move. And next week, we'll take a look and see where that is. If the INDA starts to give up the ghost a little bit, along with what's going on in the U.S. right now. So ugly day today. We'll see where we close. We'll see if we get an oversold bounce to start the week, and see on TradeFinder. We'll be able to update everything there. So thanks for watching. Have a great weekend. Look forward to talking to you soon. Take care, everybody.
If you like these recordings, I'd like to invite you to join our new TradeFinder Live, where each and every week we do a live webinar where we talk about the market, but we also go a little more in depth into the technical analysis system that we utilize to forecast where the market's likely going to go, and also to identify trading opportunities. Get your free subscription today. Take care, everybody.